Some cars don't just lose value, they evaporate. And while everyone is focused on interest rates and gas prices, a completely different disaster is unfolding underneath the surface, one that's turning once desirable models into financial dead weight. I'm talking about cars that look perfectly normal today, but will be absolute value traps by 2026. Some of these are already crashing so fast that dealerships won't even take them on trade-in. Let's break down the 10 models heading straight toward the resale cliff. And trust me, it gets worse the further we go. The Cybertruck was supposed to be the collectible of the decade, the appreciating asset, the sci-fi flex everyone thought would skyrocket in value. But the reality? It became one of the fastest depreciating vehicles on the planet. Tesla ramped up production so aggressively that dealers suddenly had months of unsold trucks sitting around. Early owners who thought they'd flip theirs for profit started panic selling when the market got flooded. A truck that cost $100,000 was suddenly worth $60,000 to $65,000 in a single year, and by 2026, with even more supply pouring in and demand cooling fast, Cybertruck values are expected to fall another 20 to 30%. But Tesla isn't alone. Another brand is sinking for a very different reason. The QX80 looks massive and expensive, but underneath it's basically a time capsule from 2011. Outdated chassis, outdated tech, outdated fuel economy, and buyers know it. Infiniti itself has been shrinking, losing dealerships, cutting models, and operating like a brand stuck between two decades. When a model redesign is coming, the current one instantly becomes the lame duck. Owners have already watched these things drop 40 to 50% within 24 months, and once the new generation hits full production in 2025, this version will fall off a cliff. But outdated tech is nothing compared to what happens when the entire segment collapses. Luxury badge? Yes. Strong demand? Not even close. The EQB is one of the biggest casualties of the EV oversupply issue that hit dealerships in late 2024 and early 2025. Mercedes overproduced the entire EQ lineup. Dealers couldn't move them, so it turned into a fire sale. $10,000, $11,000, even $13,000 off brand new models. When new cars are being discounted that heavily, used values don't just drop, they implode. By 2026, lease returns will flood the market even harder. These things will be everywhere and nobody will be lining up for a compact luxury EV running outdated tech. But if you think that's rough, wait until you see the fallout from one company's biggest fleet mistake ever. Hertz buying tens of thousands of Polestar 2s seemed smart until it wasn't. The moment EV resale values tanked, Hertz bailed and dumped their fleet onto the used market. The fire sale was so intense it single-handedly annihilated the Polestar's resale value. Brand confusion didn't help either. People still ask, is Polestar Volvo? Is it Chinese? A tech startup? When buyers can't tell who built your car, they don't trust long-term ownership. These things are already selling for 45 to 60% below MSRP. By 2026, Polestar depreciation is going to be legendary. But one model's crash wasn't caused by flooding, it was caused by becoming obsolete overnight. The original e-tron wasn't a bad car, but it was outdated before it even hit the road. Low real-world range, heavy weight, and awful efficiency made it a tough sell. But the real punch came from Audi itself. They released the newer Q8 e-tron with better range, better efficiency, better everything. That instantly made every existing e-tron about as desirable as week-old bread. Owners who paid $80,000 were suddenly being offered $40,000 for trade-ins. And by 2026, these will be among the cheapest luxury EVs on the market. Not because they're bad, but because they got left behind. But what happens when a brand abandons a model altogether? Nissan finally returned to the EV game, and then immediately pulled the plug, literally. The Ariya didn't qualify for federal tax credits because it's built in Japan, making it thousands more expensive than competitors. Sales struggled, and then Nissan confirmed it would discontinue the model in the US. A discontinued EV? That's resale suicide. Some one-year-old Ariyas are already selling for nearly half price. By 2026, this will be one of the fastest depreciating electric SUVs ever made. But discontinued doesn't always mean irrelevant. Sometimes it means financially terrifying. Lucid promised to build the future of luxury EVs, and instead created a depreciation monster. These cars lost so much value so fast that owners started tracking depreciation by the day. And the real fear, people are worried whether the company will survive. High price, low demand, slow production, financial losses, the perfect storm. If buyers think a brand might disappear, warranties become question marks, software support becomes questionable, and resale becomes non-existent. That's why $150,000 Lucid Airs are already selling for $60,000 or less. And by 2026, they'll be sitting next to used Model S's at bargain bin prices nobody expected. But the fall from luxury gets even worse. Mercedes swung big with the EQ lineup and missed. Expensive interiors that feel cheaper than they look, frustrating infotainment systems, no federal tax credits, and massive oversupply turn these flagship EVs into resale nightmares. Dealers started slashing prices on brand new EQ models simply to clear inventory. And once leases start returning in late 2025 and early 2026, it's going to be a wave of low-mileage EQs that absolutely crush used pricing. Some EQS SUVs have already lost over 50% in under 2 years, and they're not done falling. But depreciation isn't always about tech, sometimes it's about reputation. Maserati's problem has always been the same: luxury pricing, mid-tier reliability. The Levante is beautiful, fast, loud, and one of the worst depreciating luxury SUVs on earth. Maintenance is expensive, parts can be slow to arrive, and the brand ranks at the bottom of reliability charts. Now add one more problem: Maserati killed the model. A discontinued, unreliable, high-maintenance luxury SUV? That's a recipe for 70% depreciation, sometimes even more. But even the Levante doesn't come close to the #1 disaster. This is the king of resale destruction. Hydrogen stations across California, the only place you can realistically drive this car, have been shutting down or becoming extremely unreliable. Fuel costs are insane, over $180 to fill up in some cases, and some owners couldn't even refuel at all when stations went offline. Dealers have literally refused to take these as trade-ins. Some have offered only $1,000. Others list them for $7,000 to $10,000, even though they sold new for $60,000 plus. Hydrogen isn't the future Toyota hoped for, and the Mirai is the casualty. By 2026, these things will be basically unsellable. So what's the pattern behind these collapsing values? It's not just EVs, it's not just luxury, and it's not just old platforms. It's oversupply, bad timing, dying tech, brand instability, and models that got outpaced by the market way faster than expected. Some of these cars looked brilliant on paper. Some were hyped like crazy. Some were supposed to change the industry. Instead, they're about to become some of the cheapest used cars of the decade. Which one shocked you the most? Would you buy any of these at half price? Drop your thoughts in the comments, and if you want more breakdowns on cars you should avoid before they lose all their value, hit that like button and subscribe so you don't miss the next video. Thanks for watching.